A strong and stable uptrend is maintained with strength, as a gap up is not immediately filled, but is instead followed by a minor horizontal range that acts as a resting phase in a bullish continuation. When this range is expanded, it reveals a successful transition with role reversal from major resistance to support. A wide range has resistance and support easily outlined, with levels running through clear swing points and gap ranges. Similar to 2014, here is another horizontal range that has a gap up range. In this case, 76.90 to 71.20. That reverses roles from resistance to support in a long-term bullish continuation. Yet another similar situation when arriving over the 100 boundary, which incidentally marks a key upswing late in 2017 that sees another gap up avoiding a complete fill. The most recent gap down with its 120.59 opening price provides immediate resistance that is bolstered by a large bearish engulfing that forms on it into October. This is a key short-term observation because if too much short-term fixation is focused on September price action, there may have been mistakes made. This would be in the form of thinking the market was going to undergo a major recovery due to short-term bearish overextension with selling pressure decreasing after two gap downs. This coupled with a triple bottom completing were true. However, this minor triple bottom reversal would need to take into account the gap down level. Falling under 100 was a key event, as it is a classic round psychological number where market attention tends to fixate on. This can be extended to the wider 105.60 to 95.80 range to mark the overall 100 boundary. After a long recovery, EA is finally able to return over 100, but still experiences natural heavier resistance starting near the 120s, and the back-to-back gap downs that are more than enough to slow down an aggressive uptrend. Highly volatile trading attracts long-term attention because this can either continue to develop into a triple top range or end up being a failed double top that forms the resting phase range in a bullish continuation. With the break to new highs, the failed double top range now presents crucial support. In the event there is a natural dip to relieve short-term selling pressure and consolidate price at the new highs. After extended indecision, growing bearish sentiment begins to weigh more heavily on short-term bullish sentiment represented by current support from the uptrend line. These last two red spikes are the decisive breaks, not only for the minor uptrend line but for a head and shoulders pattern. As usual, there is a natural upswing after selling pressure subsided, and the chart returned back to the 133.59 neckline, where there is strong resistance as would be expected. In hindsight, the late July break over 141.25 was a weak, bullish continuation due to the presence of bearish candles, rather than large green real-bodied candles, with exceedingly high volume, not just slightly above normal volume. The descending trend line from the head and shoulders is a useful guide in gauging resistance from a volatile upswing in early November. Due to the November 6th gap down, there was short-term overselling since this immediately followed the past few weeks of steady bearish price action and volume. Now, as the market remains neutral to slightly bullish in the short term, contact with the 120 to 118 boundary is maintained. This marks the focal point of a potential descending triangle's support base. December has so far appeared to be a spontaneous uptrend. However, it is quite orderly given the substantial decrease in selling volume The 133 level and weaker uptrend line are gradually being surpassed by a steady bullish acceleration in higher closing prices and increasing green volume. This is perfect context to re-enter the Head & Shoulders resistance ranges with bullish momentum. As expected, there is progress back to record highs at the top of the Head & Shoulders range, but the earlier bullish momentum quickly declines at the 141.25 shoulder level to see slightly more selling volume and indecisive price action begin to slow down the recovery.